When we think about investment, we often think about the potential income, higher return compared to bank deposit. But every investment comes with risk. And all these risks you must think about before you invest your hard-earned money into anything, such as ETF, stocks, or unit trust. There is always risk associated with each investment. So therefore, today we will talk about the risk. And I believe most of us will heard this before. The higher the risk, the higher the return. But is this always the truth? So before we get into the content, I would like to make a quick disclaimer that everything in this video is only about my personal opinion. It's not investment advice. And in this video, I will mention some of the company names, but it's only for illustration purpose only. Everything mentioned in this video is actually factual event, but that doesn't mean it's a financial advice. It's just for information and learning purpose only. So the first risk we need to think about is currency risk. Now, the currency risk is most common when you have Singapore dollars and you want to invest in a foreign market, such as the US market. So therefore, you have to convert your Singapore dollars into US dollars and then use the US dollars to make your investment. However, the conversion rate can change over time. And as you can see by the screenshot, so the US dollars to Singapore dollar has changed quite a bit and used to be really high, such as 1.43, and now it's dropped down about 1.26. So when you invest in the US market a few years ago, you will exchange at a slightly higher rate. And when you want to convert your USD back to the Singapore dollars, the currency has dropped over the years. And once you convert the currency back, you may not make as much as you would like, because currency risk always exists when you want to invest in a foreign market. The second one is general market risk. Now this you can think about as like a weather. So it can be raining or sunny. It's not just target at a specific industry or company. It can affect the entire market. So the most common market risk is the central bank increase the interest rate. Now, most of the company would like to borrow money from bank and then can expand the business. If the central bank increase the interest, well, basically makes the loan repayment more expensive for the company. So they will increase the operational cost and therefore will reduce the profit. So which means the stock price may change. And also another common market risk is inflation. Now, living in Singapore, everyone talks about inflation because has changed quite a bit. When I first arrived in Singapore was back in 2021, and compared to now, everyone say the price has gone up. So when the price of necessities such as our daily living costs like groceries, now inflation can be seen in our necessities such as our groceries or our MRT costs. When all these necessities increase, we will have less income for buying luxury goods. And therefore, when we spend less than we used to, the price of retail and entertainment stocks may change over time. Now, this is only for general market. So this doesn't just affect the retail entertainment, it can affect all types of investments on the market. But the next thing I will talk about is a specific market risk. Now, the specific market risk is more targeted. So they are more targeted to either a specific industry or a company. So some of the common risks list down here. So first one is downgrade in the company credit rating. Now the credit rating is essential for all companies. The credit ratings are usually done by outsource, like a third party non-related to the company. Credit rating company will use everything they can find and then they will make a credit rating about this company. And the credit rating is the higher the better, because if any company got downgrade to a non-investment grade means this company is not doing well in the financial part. And this means it's harder for this company to borrow money, or the investors cannot invest in this company. So what happened when the credit rating reduced from investment grade to a lower grade? This means this company's stock is not worth for investment. So a credit rating downgrade for a company immediately increase the cost of borrowing, so which means they will need to pay for a greater interest, and also will lower the stock price, can trigger mandatory sell-off by institutional investors such as the ETF, because it's not longer considered an investment grade. Now, the next specific risk is operational risk. The operational risk can happen in any company, but that's just one example. It's basically due to a bad procedure and also some of the management side of the issue cause a disaster. And because of this, the company's stock has changed drastically in a short amount of time. Another specific risk is a legal risk. So this is a company back in the 1990s. Is quite a big case that the stock price starts really low and potentially increase to about 280 Canadian dollars. But because this company got involved in some fraudulent event, and therefore the price dropped instantly from $280 all the way down to zero just overnight. And this is actually talked about on the YouTube channel. If you're interested, you can go have a look. Now, another type of risk is what we call the liquidity risk. The stock price cannot be transferred to the money we use for daily expense. We have to sell off what we have in our account and convert that into cash. Then we can use for our daily expense. So this is how easy you can sell what you have at a fair price. Just because a stock is listed, that doesn't mean you can always sell off really fast. Sometimes even it's a popularly trade, but you can still take a few days to sell off. Now, the next one is a lock-in period. Now, this is quite common for investment-related insurance, such as like ILP or IUL. If you want to surrender, you may not get what you pay. So this is just an example only. Say this is the premium you pay every year, but if you want to surrender in the first 10 years, you can see the first 1 to 2 years you get nothing back. The third year you can get a small amount of cash back, but compared to the premium you pay for, it's not a lot. So therefore, when you make an investment decision, you must think about what is your investment timeline? Because if you surrender at any time, you are not getting back the premium you pay for. And this is an instant loss. We should avoid doing this. We need to think about our timeline for investment as well. Now, the next part is what we call a counterparty risk. So the counterparty, you can think about that every single transaction has a counterparty, somebody who want to buy, somebody who want to sell. So in the real life, this also happens, such as the big American company AIG. So AIG is basically like an insurance company that they sell this insurance to major banks, and basically when the banks has any problem of the investment, such as mortgage repayment, then the banks will go to AIG, ask for payment. However, back in 2008, the housing market really crashed in the US, and suddenly all banks are demanding the payment in the exact same time, and thus trigger a huge amount of cash payment need to fulfill. And of course, AIG didn't have exact enough amount to pay for all these banks. The demand has hit a really high amount. The US government helped to offset the debt, and basically this reached to a really high amount. And this counterparty risk can happen in any company just because AIG is bankrupt and everything invests in AIG or relies on AIG to make payment will also be affected. So this is not just on single company. It can be a chain of reaction, can affect quite a lot of people. Now, the next risk I will talk about is regulatory. So this is basically depends on the government policy. So the most famous case is this. So back in 2021, the government suddenly make a new law and basically this against private tutoring school, and basically because of this change in regulation, this company's stock has changed drastically over time, has dropped drastically, and this can happen quite sudden. And the last risk is time. Now, the time doesn't mean the locking period is about our age. So when you want to invest, if you plan early, such as you start in your 20s, you just start working, it will be easier to plan than when you are 60 approaching retirement age, because the more time you have, you can afford to make some mistake. So if you make a bad investment decision in your 20s, we still have time to earn back the money we lost in the investment. And I believe most of us did a bad investment at some times in our lifetime, and it's quite common. But if we are young, we still have time to earn back the money we lost in a bad investment, and we can start over again with careful planning, or we choose something else to invest. If the investment gone back, or if the market is in a downturn, how long we can wait until the market comes back again. So this is another risk we need to think about. So at the end of this video, I also want to talk about asset allocation. If you invest all your hard-earned money into one asset, and it will be quite a risky move, because if this one asset has gone back, such as all these risks above or during a market downturn, it will impair you quite bad. But if you diversify into different types of investment, then you can diverse your exposure. So if the market is quite bad for some of the stocks, but your other investments are doing okay, so can kind of balance out. So therefore, before we get excited about the potential return of investment, we also need to think about what are the risks, and whether we can handle the risk is also another question we need to ask ourselves.